Hello, hello. Okay. Hello, hello. Hey, Scotty. What's up, Char? I'm sorry, I'm reading your message. What's up, Big Joe? All right. Cool. We'll wait a minute or two, let people join, and we will start. A lot to talk about today. So this is the first current market conditions lecture that I've done in actually quite a while. Right now, I am currently in my second to last semester of college, doing a lot of upper level classes, and my schedule has gotten a little busier with some other projects as well. I know some of you are aware that I'm a licensed contractor now, and I've started building some residential properties myself, which has been fun. Those have just taken a lot more of my time, so it's been a lot more difficult to schedule these lectures. But I am glad to be back behind the driving steering wheel and excited to talk about the market with you guys. Crazy. Yeah, it was a little bit more, volatile. And that's going to be a theme that when we start talking about election years, there's actually a very interesting trend that we can, go over. But volatility is one of them. Spoiler. Election years are typically some of the more volatile years in the 4-year cycle. So hopefully we can take a bit away from that. Okay. Yes, thank you. I'm excited. Being a contractor has been fun. Um, you're in the Florida Panhandle. Oh, I lived in Tallahassee for a while, actually, but I currently live in Provo, Utah. So I'm doing some projects here, building some spec homes on the side, and that's been a lot of fun. Hoping to develop a neighborhood at some point in the next 5 years. So that's sort of what I'm working up towards, building my business towards, and then trading on the side. So quite a lot going on. So apologize if it's harder to do these lectures. Okay, let's start. Hopefully more people continue to jump in. But today we are, again, kind of as I mentioned before, we are going to be doing a current market conditions lecture. For those who don't know or haven't been to these before, I basically break down the broader market, mostly the S&P 500, but we do talk about the other indices as well. And I essentially go over everything that I feel like is important to know right now in the market. We talk about some of the past price action in the last couple of weeks, as well as current patterns and levels to the upside and to the downside. We don't necessarily just make picks or predictions in one direction. We like to have levels and options for both or multiple outcomes as the market is volatile, and especially as we enter this election year, should expect volatility in 2024, even beyond what we've seen in 2023 and potentially 2022. So let's jump right into it. Again, if there's any questions along the way, feel free to ask. I might not get to them immediately, but I will do my best to make my way to those questions at any breaking point. Am I looking to own real estate as well? Yes. Ideally, I want to own multiple properties to pay rental income that can fund some of my future projects. So eventually, yes. Okay, do I think SPY can see major pullback? Well, let's talk about it now. Let's break down everything here. We're on the SPY ticker ETF, again, S&P 500 ETF that I like to use the most. There's a couple of options. On the daily chart, right, and when we're looking at moderate time frames to longer time frames, and even sometimes in shorter time frames, the daily chart is very useful as it shows a lot of price action, and it shows a lot of reliable price action, right? The longer time frames that we have, the better indication of trends that we can see, and the daily chart is very good at that. Obviously, the market is on quite the rally since about the middle of October. We had the November and December rally. We talked about this in a current market conditions lecture a few months back. One of the last ones I did, actually. November and December typically are fairly positive months for the stock market. Usually there's a nice boom. We could look back at a couple of years past, but even on years that were red in general, we have seen end of the year rallies. And there's lots of reasons as to why that is the case. We're no longer obviously at the end of the year, so it's not as important to know now, but usually the market rallies at the end of the year. And usually the market has a good January. When we have a nice rally at the end of the year, the market does well in January. There's the old saying, sell in May and go away. Basically, that the first couple months of the year usually are pretty decent for the stock market, especially in election years. And we'll look at some statistics on that in just a minute. I have some cool graphs and things to share. Again, they're not all mine. I found a lot of these online, but it's better than me making a poor looking graph. So we'll look at those in a second. Also, the market, again, usually tends to stall after May, right? We have that little summertime lull. A lot of reasons, again, as to why that's the case. But the main takeaway here is usually markets do fairly well at the beginning and the ends of the year. Right? It's usually the middle up to about October that is poor. So, again, this is not too unexpected, but the level of upside move has been pretty staggering, right? We've seen a lot of, at least for the first 2 months or so, we've seen a little bit of resistance in the last couple of weeks and couple of days, more specifically. The first couple months, very strong uptrend from the low that we had back on October 27th to the high we had technically yesterday. We are up 16.8, 17%. That is crazy for, again, about 2.5 months, right? And even at one point it was 2 months and we were basically up 17%. That's pretty wild. Again, the S&P averages about 10% a year, give or take. So 17% in 2 months that's a lot. So even the chart and a historically bullish and very strong 2023, we still, these last couple months were even stronger than the rest of the year's trend. So a very good start to the year, and as far as our very good end of the year and actually a decent start to the year. We are now right at all-time highs. So a lot of you guys haven't been trading necessarily since stocks were last at all-time highs in January of 2022. I don't believe we have technically quite reached that level again. But this is a Fibonacci retracement of all-time highs. It's slightly off. It's the all-time high price was about 480. We have yet to break that now, but we have made our way essentially from the low back in the middle of October 2022. So a little over a year ago at about 348. We made our way all the way back to about 475 and at one point about 478. So we are within now a couple of dollars of all-time highs. A substantial move for the market, a very impressive end of the year. Now, there's a couple things to be aware of. One is that if we do make all-time highs, which again, we still have not, I like to see a daily close above the all-time high. So I want to see a daily close above 480, right? That will, to me, be legitimate all-time highs. The statistics say, and I don't have graphics or anything to prove this to you, but I promise it's true. Statistics say when the market or a stock, this applies to both, when they reach their all-time high, they are more likely to continue higher than they are to retrace lower. So if SPY can make an all-time high, then we are likely going higher, as far as history says. Okay, that's a trend, not just for all-time highs, but for highs in general. When stocks make new highs, they are historically more likely to go higher than they are to start going lower. Okay. We have not quite reached it yet, and it is actually a bit significant that we have not. It seems like the market has been trying to make several attempts to break into the 480s, have been unsuccessful thus far. But again, should we get a daily close in the 480s, likely signals that we are going higher if history has anything to say about it. Now, as far as how high we're going to go, it gets a little trickier because at all-time highs, there's not necessarily levels to go off of as we're at price levels that have never been seen before. However, I need to make the disclaimer. I'm seeing everywhere, everyone's talking about stocks making all-time highs, that you should have held all your assets from the bottom. And that's technically true. The thing is, we're at all-time highs before you adjust for inflation, right? The last time we were at all-time highs was early 2022 when inflation was still relatively low compared to what it ended up becoming. Thus, if you adjust for inflation, we still are, I believe, about 15% from all-time high. So we're well into the 500s if we're talking all-time highs in real terms. And that is, again, adjusting for dividends, etc. So we haven't made all-time highs in real terms, but we are close in these sort of nominal terms, meaning, you know, the numbers are the same, but the numbers don't mean the same thing that they meant 2 years ago. Also, if you would have told me about 2 years ago it would take 2 years to make it back to all-time highs, that would have been really shocking to hear, right? It's crazy. It's taken 2 full years to recover what we lost because of this inflation. Okay, so again, all-time highs, a little bit hard to discuss. I am hosting a lecture 2 weeks from today. We're going to be talking about trading stocks and the market and other things when they're at all-time highs. That would have been applicable today, you know, but we're going to wait on that for 2 weeks. We'll talk more there as far as methods to trade. I'm mostly just going to be giving outlook here and information. Okay, so again, all-time highs, very likely to come here shortly. One thing to note, though, we are seeing a bit of a stalling in terms of volume and price action, right? We're not quite seeing the same parabolic move to the upside, which is to be expected. You don't see these straight up moves forever, right? You get some retracement, but these 2 months from late October to late December, we essentially saw almost no major pullback. We didn't even really break below the 9 EMA really at all, right? We bounced off it multiple times, showing a strong uptrend. We did break the 9 EMA. I mean, right at the end of the year, like the last day of the year, first day of 2024, we've sort of lost the momentum. We have slightly made new highs, but we did lose some of that today. So just as far as, you know, divergences are concerned, we do have some bearish divergence on the daily chart. Again, that's really only significant because it's on the daily chart, right? You can see when you have these divergences on the daily chart, Let me zoom out. They do, in longer terms tend to play out, right? Here's an example. Looking from middle of June to end of July, the market was making new highs, right? A lot stronger new highs. And the oscillators were kind of hard to see here, but the oscillators were making lower highs. So we were seeing the relative strength per se declining despite price action increasing, seeing new highs. That is technically bearish divergence. We have some decent bearish divergence here. And again, not necessarily there's a lot of ways to play this, and I'll explain what you would want to do. But when you're looking at this sort of chart, right, you're not necessarily looking at the peak of the divergence to fall. You're looking at when price action does roll over, right? So you see here we do have, price action making a couple of higher highs, though very slight higher highs. The oscillator is making lower highs. And now again, this is technically sort of a triple to quadruple bearish divergence, depending on how you use the terminology. And again, that doesn't necessarily mean that we're going to pull back. If price action confirms the uptrend again above all-time highs, that probably means that we're continuing higher. Though, sorry, taking a quick sip to my throat. It's a little bit dry. Though this is not necessarily a good signal for the bulls, doesn't necessarily mean we're going to roll over. So basically, we're continuing to see price action go higher, right? Let me lower this. But some of the alternative ways of looking at the market are not, supporting this move higher. For example, right, we're seeing a decline in volume. It's a bit hard to see. Let me erase this. We're seeing a decline in volume. Again, to be expected off of this crazy rally to the upside. But it is, quite substantial. We were seeing days in the 130s, 140 millions. We're down to, really sub 100, some days sub 70. Today was a little higher, but it was a day of selling pressure. Right? We've seen 3 consecutive days of selling pressure winning, though the bulls have been able to buy us up, right? You've seen it the last 3 days. We've seen some selling pressure, and the bulls were able to buy us back up, which does, again, confirm some of that strong price action for the buyers, but it is weakening relative to what the sellers are starting to be able to do. So it would have me a little bit nervous to really go long here until, again, we can see all-time highs. That's what I'm looking at. Though if we start to roll over, right, and get some lower lows, we could be in for, a longer term retracement. So the last level, right, we did bottom out at about 466. This was a couple weeks ago. I don't think that we're in a downtrend until we make new lows, get a close below this. We continue to make new highs, higher highs until we have lower lows. I can't say, anything about the trend. The trend is still bullish. But if we do see a close below 466, I would, potentially expect a retracement, maybe to the 451, somewhere the first Fibonacci level. But again, we're going to expect some volatility this year. Don't think it's going to be as smooth sailing, right? We are likely to go higher given the history. We usually have a positive performance for stocks in election years, but there's usually a lot more volatility. So there's a lot more dips, there's a lot more rallies. So there's more potential to make money. There's also more potential to, again, lose your lunch. So we'll go over some of those things in a minute when we go look at historical stock market returns. We're close to that. I'm trying to remember what else I wanted to mention here. We can look at longer time frames too as well. I do want to get to those statistics. Okay. Don't think there's much else I wanted to mention right now. Here, let's go look at some of those statistics, talk about election years, and then we will continue with the charting. We still have quite a bit of charting to do. I just want to, sort of take that break and go there now. So let's make a new share. Here we go. Okay. Can everyone see this graphic? I believe I don't remember where. I think this was JP Morgan or something. All right. Can everyone see this? Cool. Okay. If you can't, say something. Okay, so this is the S&P 500 returns on election years since the founding of the index. So I don't like looking at the really, really old ones, right? Because things were very different back then. I really like looking past 1952, but we're going to look at all of them. There have been 23 elections since the S&P 500 index began, and it was in the 20s that it began. And 19 of 23 years have provided a positive performance. Okay, so very usually we have a positive performance in election years. Okay, that is, the standard for election years, right? Now it does vary depending on the candidate, right? We've seen, well, let's look at these negative return years, right? There's been 4 years that have been negative since, this began. The first one being in 1932. Obviously had a lot going on there. We had the Great Depression. We were kind of in the middle of it. Obviously one of the greatest, if not the greatest, financial crisis the developed world has ever seen. That we had a negative return. We also had a negative return in 1940 as we were on the onslaught of World War II, right? Pearl Harbor had not quite been bombed, but global tensions were rising. Stock market had a negative performance. We didn't see another negative performance after 1940 until 2000, where we had the dot-com bubble and the burst. And then obviously 2008, we had a horrible year for the stock market, a minus 37% return in the beginning of the Great Recession, the housing market bust, etc. So those are the 4 times when we have seen a negative return in election years. And all 4 of those were major, major global events that you could make the case that all 4 were outside of the effect of the stock market. They were global events that ultimately negatively impacted the stock market, give or take. Some of them, not so much. What this says is that unless there's a major global, negative event, usually we have a positive return in election year, right? And that negative event, there's a difference between a negative event and having a negative year in the stock market. That they're not necessarily correlated. For example, 2022, we had a really bad year in the market. There was a couple of things that happened, but there was not necessarily a single event that pointed to that. It was mostly high inflation, right? Higher rates, and some global conflicts, especially in Ukraine. So again, some of those reasons as to why that was negative, but there wasn't a global recession or a global depression. It was smaller things that led to the decline. In election years, you don't usually see that. Usually in election years, you only see negative returns if there's a major event. Okay, so if there's a major event, that does not bode well for the market, right? Just given the history of election years. Okay, so there is a difference between Republicans and Democrats as far as average return. So it's a little bit tricky to explain, but if a Republican is elected, so in this case, if a Republican enters office in early 2025, the average return and that year for the market will be about 15%. If a Democrat gets elected, meaning a Republican, or not necessarily, but if they get elected, the prior year had a return of about 7.6%. So it's typically a little bit better returns when a Republican gets after. So it basically says if the market performs well, a Republican is more likely to get elected. If the market performs a little bit less well, a Democrat is more likely to get elected. You can actually use this a little bit in making election predictions. By the time we get to November, right, we still have 10 months until the election. Depending on how the market has performed in 2024 up to that point, can give a little bit of a signal of maybe who's more likely to get elected, right? If we have a really good year, if we see above 10%, 12, 13, 14%, means that we're potentially likely to get a Republican for whatever reason. And On the opposite side, if the market's a little bit less great, potentially more likely to see a Democrat elected. So very interesting. The average return in election years is 11.28. All right. So above that expected 10% return, election years are typically better, right? And if you look, there's only a couple of years they've been down, -8%, -10%, -9%, and -37%. So outside of really one major outlier, usually not major crashes in the market on election years. Okay, Norberto asks, do we think Trump wins if we can get the 2021 stock market whenever stocks rally? Well, at this point, Trump or Biden either could win. Obviously, there's no consensus. It is a bit different because in the last election, it seemed like Trump was a little bit more unpopular. I feel like I know his approval rating has actually risen. And according right now, Trump has a slight edge against Biden, so we'll see. But for those saying that Trump has no chances, that's just not true. As far as statistics go, looks like he actually has a better chance to win now than he did back in 2020 at this point. Okay. What else did I want to look at? Here. Okay, when a Democrat was in office and a new Democrat was elected, the total return averaged 11%. Okay, when a Democrat was in office and a Republican was elected, total return was 13%. So not a major difference as far as, the scenario we have right now, because right now, obviously, we have a Democrat in office, and there's two outcomes. Either we go from Democrat to Democrat or go from Democrat to Republican. And again, the difference between these two outcomes is, again, not significant. So take with that what you will. Are there any questions on this little graphic? I know it's not as much as maybe you expected, but happy to answer some of these questions. Okay. Nathan asks, what about the need for rate cuts? Don't we have a catalyst to actually have those rate cuts take the interest rates back down? Yes. We are going to have rate cuts this year. So that is another something else to keep in mind. The Fed has announced that they plan to have several rate cuts this year, bring us down from these record in the last 30, 40 years interest rates. We're going to see them cut probably a percentage or two. Still going to be relatively high interest rates at the end of 2024, but we're still going to have multiple cuts. When we do get cuts, again, Econ 101 and Market 101, when the rates start to get cut, the market tends to do well and there's a lot of reasons why, but the main reason is when rates are high, there's less incentive to invest in the market because you can get a 5% yield on, just interest by keeping your money in a savings account. Why take a risk of putting your money in a volatile market when you're guaranteed a rate that does beat inflation right now, right? So when rates drop, there's a little bit less incentive to keep your money in a savings account. You're yielding less. So we start to see an inflow from money in on the sidelines into the stock market. And that does, again, put more money in circulation. Okay, this is the next point I wanted to talk about. Nathan is bringing up. The market has priced in, a good chunk of rate cuts. I don't know if it's 7, but there's quite a lot. If we don't get those, it will take us back down. And that is also true. So don't just think because we get a rate cut that we're going to rally. If the Fed comes out and says, we're going to cut, but we're probably only going to do, say, 1 or 2 more cuts this year, we can have a rate cut and a market, declining. And that's because of how the Fed, words it. The market now has an expectation of several rate cuts, and that's partially the reason that we had such an amazing end of the year last year from November, end of October to really early January, is because of the talk of declining interest rates. So if we get to a point where the Fed starts to discuss maybe cutting rates 3 times or 2 times, depending on how inflation works, if inflation's coming back, maybe there's incentive to cut less. Lots of reasons, but if we get less cuts than now expected, we will definitely see the market suffer from that. Um, but yeah, if we do get a substantial rate cut, I would expect to see the markets continue to rally because of that, inflow from capital on the sideline back into the equity markets. Okay, any other questions? There was one other point I wanted to make. Very interesting. Historically, the year before elections has actually been substantially better than the year of elections. Go just look back in history. That is very clear. Here, let's go back to the chart. And I'm going to zoom out and sort of display this. I'm going to do a yearly chart. I don't know if I've done a yearly chart before. Okay, year, and let's go back as many years as possible. Okay. Whoa. All right, yearly chart. Okay, let's look at the year before election years. Historically, again, on election years, we've averaged, according to that graphic, about 11 to 12% on election years. On the year before election years, we have averaged about 17%. So usually the year before an election year is better than the election year. So this last year from 2023, we had, oh my goodness, we had a return of about 25%. So according to history, we're likely to have a positive year, but we're not very likely having another 25% return year. So, but again, year before election year, 2023, very positive, right? The year before 2020, which was, again, the most volatile year I have ever seen. 2020 was technically up 15-ish%, but from the bottom, right, from where we were in COVID, I mean, we rallied like 70%. Those who don't remember, from the March lows in COVID to the end of the year, we rallied like 71%, which is absolutely crazy. So again, volatility. But the year before that was a solid 24.5% year. So that was similar to what we had this year, the year before an election year. So expect, again, volatility. Not like this. This is hopefully a once a generation type of move. I mean, the stock market crashed like 30% in a month, a couple weeks. Hopefully we don't get that again, but expect the volatility in the story to be the same. Then you go back to 2015. Yeah, I guess it's 2015. 2015 actually was not, that was one of the few years actually in the last little while that wasn't, green before election year. 15 was actually very similar to 2022. Talks of rate hikes, sort of a fear in the market. Obviously not as volatile because the rate hikes were like 1%, if not, but now compared, it's a lot different. And then even before that, I guess 2011 was a bit off, but then again, before that, 2007 was hot. 2003 was hot. 1999 was hot, right? So 1995 was hot. The year before, again, election year is usually stronger of a year than the actual election year. So take with that what you will. Yes, perfect. Okay. Would you monitor one factor of inflation in gas prices, considering they're down like $2.50 from their all-time high? Would you say what's going on in the Red Sea with Yemen and our cargo ship getting attacked? Would you put some position on war stock for leverage? No, I never really like to gamble on war. I feel like not necessarily immoral about it, but I don't like to make the bet. I don't know. I also don't think we're going to go to war over something like that, personally. But yeah, oil prices this low, yeah, it's definitely having a positive impact on inflation as far as, declining, right? We've seen a dramatic decline in oil prices over the last year, I guess, give or take. And the main reason why that's the case, Norberto, is American domestic production of oil is at an all-time high. We're producing more oil now than we were in January of 2020, right before COVID. So we are producing more oil than we ever have, and that has thus lowered the price. So again, Middle Eastern conflicts, they have an effect, and they definitely will impact the price of oil. They're not going to impact the price of oil as much as they did 2 years ago. And that's because our domestic production of oil 2 years ago was pathetic. But because we're producing so much now, these conflicts in the Middle East will not have as much of an impact on oil prices. And thus, we're not going to have as much of supply shocks. Thus, we probably aren't going to have as much volatility in oil prices. But again, anything can happen. That's just, you know, history. Let's see. Anything on the weekly chart to 5 years and week. Okay. Yeah, so we did also mention weekly chart is another chart to look at for, some bonus information. Reason being, when you get substantial divergences on the weekly chart, they mean a lot more than any other time frame. So when you look here, we have very, 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 very slight bearish divergence on the weekly chart, right? We're getting higher highs. Price action is declining. Relative strength is declining on the weekly chart, lower highs. That's not too big of a deal yet, but that can become a big deal, right? Let's look at a similar example, right? About 6 months ago. So again, lower highs, slightly lower highs in the oscillator, slightly higher highs in the price. We had the exact same thing happen, give or take, happen back in June, right? We're getting slightly higher highs in the price, slightly lower highs in the oscillator. That wasn't quite enough, and we ultimately did rally much higher before we did reach that breaking point where we had a pretty substantial pullback in the market, right? A 10.9% decline in prices. So what this might be inferring is maybe we see another push to the upside, break those all-time highs, and that's when the oscillator rolls over and we see a decline in price action, similar to June. So a lot of things could happen. Keep your eye on this though, right? I don't like seeing even a little bit of divergence on the weekly chart. That is typically not a good signal. Doesn't necessarily mean we're going to fall, but it's definitely not a great signal for the bulls. So keep your eye on that. Something sort of important to look at. All right. Let's see. 6. Okay. 7. We have a little bit of time. Let's keep going. Let's look at the cues. The story with the cues is actually a lot more dramatic as far as divergences go on the weekly chart. So when you see this kind of situation, it is usually almost always a fairly bearish situation. Right now, we do have something that happened on the weekly chart that you don't usually see. Okay. We have a very substantial divergence on the weekly chart, right? We have substantially higher highs in the price, right? Like pretty substantial, of 6 to 7%, and substantially lower lows in the oscillator. Okay, so again, this is on the weekly chart. Usually, if this was on the daily chart, not as big of a deal, but this is the weekly chart. That's a very, very big divergence on a very long time frame. I do think tech stocks will very likely pull back, in my opinion, just given the nature of this divergence. Again, historically, weekly chart divergence play out very well. And even if the move isn't substantial, the move happens usually every time. The other main one, it's a little bit thrown off by COVID, but we had substantially higher highs in price, substantially lower highs in the oscillator. For those who do remember, I definitely remember this week, this little period. I absolutely got smoked here. We had a 14% drop in about 3 weeks. Obviously, we recuperated that and much more, but this was a very quick decline that caught most people, including myself, off guard. Another weekly divergence that we've seen recently is here. We had higher highs in the price, substantially decent lower highs in the oscillator. And obviously, this was the beginning of a major, substantial decline of, I believe, about 37%. Big decline. We have the exact same signal here. Again, so I'm not implying we're going to fall 37%. I'm not even implying we're really going to fall at all. I'm basically just saying when we've had this before on the weekly chart for the Qs, it has usually been followed by, some decline of decent threshold. So what we have here on the weekly chart is we have a very, very, very obvious cup and handle pattern, okay, for the Qs. Major rally, a cup bowl, whatever you want to call it, back to the high. The next phase, if this continues, again, it doesn't necessarily mean to continue, is a steep decline and followed by a rally to the upside. That's what the cup and handle says. So there's definitely a chance that we, get this steep decline from some, maybe this divergence is kind of showing that price action's weakening. We get that steep decline. Maybe it forms the rest of the handle. Regardless, I think there's going to be a bit of a decline. And just off of this chart, again, if we continue to make all-time highs and push higher, that can be invalidated quickly. But again, this is really powerful, strong bearish divergence on a very long time frame. I usually and really have never seen this not play out at this magnitude. We've had 4 examples in the time I've been trading. This has happened 3 other times, and all 3 we have seen a major move in the direction that is implied. So again, I do follow that. I think we're going to have a major move. So I'll be honest, I am a little bit hedged to the downside in the shorter term, because I think if we do pull back, I think it'll be sooner than later. My outlook for 2024 and even until May is actually fairly positive. I think the market is still primed for more continuation to the upside with the seasonality and the strong case that the election year provides. I just think this is a technical pattern that I promised myself the last couple times it happened that if I saw this pattern again, I wouldn't sit on the sidelines and that I would, take action. So I am playing the downside. Maybe not what people want to hear for the Qs, at least, right? I don't like this price action at all. So maybe they prove me wrong, maybe they don't. But this is what I'm seeing. So I'm just being straight up. Now you might have a completely different, way to look at this, and that's totally fine. There's a decent chance that this doesn't play out at all. So I'm just basically making my case as to why I think tech stocks are likely a bit overvalued and, according to price action, maybe due for a pullback. All right, any questions on that? There's quite a bit, a little much maybe. I am all ears or all eyes for reading. No questions? That's fine if there's not. Okay, let's look at the Dow really quick. Dow's different, not as actually bearish, which makes sense actually with the same narrative. Dow's a lot stronger in my opinion. It's does not have the overweight of tech, right? Sort of making me nervous. It has done very well. Does not have those same divergences. So if you are short something, I would be short the Qs, not the Dow, not even really SPY, according to just the charts. QQQ looks like it has some gaps to fill. Yeah, it probably does. So again, I'm not saying we're going to have a crazy 20% decline, but I think we're going to drop in tech in the next couple weeks, over the next couple weeks. Could be wrong, so don't play what I'm saying. I'm just giving you the reason why I'm playing more short for the next couple of weeks. And if I'm proven wrong and we continue to make new highs, that's totally fine. We can uh, play the upside. It's not. I'm just saying that's how I'm positioned currently after some of these major weekly divergences that you don't see. I mean, literally, you see maybe one of these signals a year, and it has a success rate of like 100%. So just be careful. Again, just because something has a 100% success rate doesn't mean it's going to happen again. Just means I'm gonna probably take the chance on that. Not much to talk about with the Dow. Let's look at the dollar. That has been quite the story. So the dollar has had, again, a pretty steep decline over the last couple of months, which makes sense given the rally in the market. Got up to about 107. Again, this is the DXY index, so it's not based on anything. It's just a relative index. The peak for this was at the end of 2022, when the market was at its low at 114, and now it's at about 103.30-ish. So this is inversely correlated with the market typically, right? When the dollar rallies, the market usually drops, and vice versa. They're connected with each other. We're getting a bit of a rally again in the dollar, actually, from a low of about 100. Dollars gained 3% relative to other global currencies in the last 3 weeks alone. That's actually pretty substantial. So keep your eye on this. We did, again, you don't really get divergences with the dollar, but we had another bounce right on the 200 EMA, which is interesting. We've had quite a few of those. So again, I am bullish dollar now after this decline. I've been sort of shorting the dollar in proxy by playing the long side of the market for the last couple of months. At the point now where I'm getting skeptical. So I do like the dollar to the upside at a strong resistance level. If we can continue to break these levels though and make more upside, there's a lot of upside in the dollar, a lot of downside in the market potentially. If the dollar, again, this is another index, if the dollar starts failing to find strength, rejecting, could be an index that the market, going long on the market might be a good idea, right? If the dollar starts to fail, continues this decline, good case to be made for going back long in the market. Then also, obviously, talk about the VIX. And a lot less interesting in recent months, but in recent days, like today, we had quite the gap in the VIX. I had a low of under 12 for the VIX. That's crazy, right? You don't see the VIX at those levels, I mean, almost at all. But we did get that, uh, at the peak of this rally. We're starting to see volatility sort of creep back in. We're likely to see some volatility now. You get a lot of volatility usually when you make all-time highs go higher, because eventually, you do start to have a little pullback. You don't just go up forever, and it is how the bulls respond to that pullback that can determine the next leg of the market. So, again, if these dips continue to be bought up, you can't do anything but go long. If volatility continues to spike, despite sort of a lack of move in the market, probably means that we're due for some downside volatility. Okay. Don't play downside volatility or don't play these things until you see signals. I think I see signals to justify maybe a little bit of a downside bet. And this is coming from someone who was fairly bullish for the last 2 months, right? I've been playing the upside. There was a lot of signals then in October that said maybe we were due for some more upside. There's a lot of signals now saying that upside might have sort of seen its best days. Are there any questions on this information? Okay, there's no questions. I think I've covered mostly what I want to. I guess we could look at oil too. That'd be interesting. Yeah. Okay. I don't know why that line's here. Okay. Lots of, again, oil prices have been from their high of 95, sort of in September, to their low of 67 in early December. We kind of stalled out here. We're sort of chopping, a lot less volatility actually in oil, which has been a very volatile commodity over the last couple of years. Very much stalling out, which is actually unusual for oil, right? Usually these stalling outs have led to larger moves, but this chop in price action can last quite a while, to be honest. So we might chop for a while. We're due for a break. I don't know if it's to the upside or to the downside. We're likely going to get some big movement here, as this price coils. So again, watch that. But also, I mean, prices are down. This is one of the best indicators to look at for inflation, right? When oil prices are high, get inflation scares because everything gets more expensive if oil's more expensive, right? Because oil is what we use to transport, right? Vehicles use oil to transport. So when transport goes up substantially, that's when the price of goods go up substantially as well. So again, watch oil, but honestly, we're very subdued. I don't think we're going to see oil be a big factor in inflation talks for, the foreseeable future, but that can change very quickly with some major breakdown, anything in between. All right, I wanted to actually look at Microsoft because I know Microsoft has very recently overtaken Apple as the largest company in the world, which is crazy because I have been watching Apple dominate for quite a while. Basically, the entire time I've been trading, Apple's been number one, or it was either one or two with Saudi Aramco. But with this recent sort of decline in Apple from 200 down to, I mean, we're at about 183 now. Microsoft's the top dog for the first time in my trading experience. Some similar things though here in Microsoft as the Qs, right? Very same thing happened here in June to July. Substantially higher highs in the price. The oscillator though continuing to make lower highs. Very similar here, right? We had a nice outburst, lots of upside. Hope you played the upside, but again, starting to see this lower oscillator here can be a bear signal. So again, the rule 101 of trading is when stocks make new highs, more often than not, they continue to go higher. So again, this does go against that logic. However, you do have this divergence. So again, we haven't really stalled yet. We peaked at 393 and we are down, a little bit today as far as from where we were at the high, still up on the day. But if price action can't continue to make new highs and we really start to stall, sort of like what we're seeing in SPY, that could be a very bearish signal for Microsoft, which has plenty of room to fall. So just keep your eye on that. Not making any, claims of damnation and hellfire, but just basically showing, making the claims that the charts are showing that this upside's been great, but we're probably seeing the end of it. And if we are seeing more, we could very well invalidate these signals. But for now, these signals do exist. Any questions on this? Okay, repeat what? What part do you want me to repeat? Okay. Again, so typically when stocks make new all-time highs, like Microsoft has done here, usually you continue higher, right? So common trading knowledge says when, the market is pointing to the upside, price is strong, you make new highs, you're likely to continue higher. But these divergences say, price action is weakening, right? We have seen relative strength decline until relative strength rolls over, which it hasn't, meaning it starts pointing back downwards, right? Because we're at a lower high doesn't mean we're curling down. When we start curling down, that's usually when, we get the larger pullback. So conventional knowledge says Microsoft's going higher based on new highs. This logic says if Microsoft can't hold these highs, there could be potential for quite a bit, a decent bit of downside. So it really depends on the next couple of days, next couple of weeks, whether or not we really see those moves. Okay, any other questions? Back to SPY, 460. Okay. All right. I mean, if there's no other questions, I think we're going to wrap up. Thank you guys for coming out tonight. I do again apologize for kind of being MIA the last couple of months. Things have just gotten to that point for me. If you and again, I hope this lecture was useful. I did put a lot of thinking into how I want to present this, and I do hope that this was insightful. Not again trying to sway any necessarily bias of how to trade right now, just giving what I'm doing based on what I'm seeing, and hopefully give you some sort of a trading plan for the potential outcomes. I listed the main outcomes of what could happen and how I would play both of those scenarios. So I do appreciate it. Thank you guys for coming out. I will be hoping to do, these lectures more often. At the very least once a month, it may potentially more, depending on if people actually like them and get information out of them. But again, 2 weeks from now, I will be doing a lecture where we discuss trading the market at all-time highs. Probably would have been better today with how close we are to actually at all-time highs, but we will see where we are in 2 weeks. If we are still at these all-time highs, it'll be very interesting. If we're not, it might be less interesting. But thank you for coming out. I will talk to you guys all next time.